Good morning, everybody. It's great to be here. I've been coming to Chisinau since 2016 when we started Agile, and it's been an absolute delight. What I'd like to do is probably talk about some subject material that you may not have realized. And I know that many of you work in banks, some of you work at the central bank, so you'll hear some themes here that they'll resonate, but I'm going to try to connect some dots and hopefully bring some transparency to a business that's otherwise not very transparent. Let's see, I may need some tutoring on how to use this. Okay. There's a little green button that says to the right. You just have to pay attention to that. So it's, first of all, you may be shocked to realize, but cross-border payments through financial institutions exceeded $160 trillion last year. I mean, our global economy depends on cross-border payments. But we've got a big problem, and it's recognized by everybody. Cross-border payments are high risk, opaque, inefficient. Inefficient means slow and costly to the ecosystem, and they're not inclusive. And the reality is that it's not the bank's fault. It's not the central bank's fault. And I'll sort of walk through what the root cause of the issue is and how it's being addressed. But there's a global recognition by not only the US Central Bank or the US Federal Reserve Bank, but others that this is a big problem. I forgot to mention as well, I've been an industry advisor to the Philadelphia Federal Reserve Bank since 2005, first at the Payment Card Center and now the Consumer Finance Institute, and I'm obligated to say that these comments are my opinions, my views, and not that of the US Federal Reserve Bank or the Federal Reserve Bank of Philadelphia. So just stating at a high level, cross-border payments are inefficient, high risk, opaque, and not inclusive. What does it mean in terms of the numbers? Well, it's kind of scary that according to the United Nations, up to $2 trillion a year is money laundered through banks. Now, again, having come to Moldova in 2016 and been a resident of Kiev for a while before the war started, we've all experienced some money laundering challenges through financial institutions. But if you're a financial institution today, an EMI or a bank or a mobile wallet, and you are, or a fintech, and you're serving customers who need to make cross-border payments, the classic way you've done this is through correspondent banks. But the problem is the number of correspondent banks globally are declining. Not only are they declining, but we work with a number of banks in Central Asia that spend an average of $250,000 on consultants, lawyers, and other advisors trying to convince BNY Mellon to give them a Nostro Vostro account. So there's a tremendous amount of waste and inefficiency that goes into the process of just trying to get a correspondent bank. And it's getting worse. Now, on the first slide, Chairman Payall noted that there was a challenge keeping up to date or delivering on anti-money laundering policies, but nearly half the financial institutions globally report that their AML software is outdated. And they've paid $10 billion in fines for this a few years ago. Now, if you're a bank, you're losing market share. So the situation's kind of bleak. But the fact is, again, it's really not the bank's fault. And this isn't just a problem acknowledged by the US Fed, but also the G20 as well. So what's the real problem here? Why is it that cross-border payments are opaque, are inefficient, are high risk through financial institutions? And here's the reason why. Since SWIFT was started as a messaging platform 50 years ago, and over the last 50 years, and this is a really provocative fact, there's never been a core bank system or a digital bank platform ever built to automate all of the risk and the compliance and the standard operating procedures of the origination of a cross-border payment. And inside a correspondent bank or an intermediate bank or a central bank or a domestic payment network, there's never been software built to receive enriched data that's necessary to bring transparency to those payments and to automate the risk and the compliance and the other product requirements, product processes for that payment. So what's the result? Literally every day, millions of people around the planet are looking at these payments and processing the risk rules and the compliance rules one by one. This is why these payments are so expensive, so slow, and so problematic. Now, one of the things that the fintech industry tends to do, and my first company built the first ever issuing processing platform for prepaid cards in 1996. When we sold the company in 2005, 7 of the 10 largest US banks were our customers. Banks all around the world were customers. We were considered the first fintech. But at the time, everyone was excited about the fact that we had published APIs that allowed for interoperability with businesses, because with prepaid cards, it's not a debit card or a credit card where the bank is just issuing the card to a consumer, but we were working with payroll processors who were distributing cards and loading value. The American Red Cross was loading value after disasters, insurance companies. And so this concept of APIs was exciting. And if you think about the world today, everyone talks about all the APIs that allow for interconnectivity, and you talk about advanced Swift 222 messaging, or 222 messaging. But the reality is, if the touch points of those messages are incapable of executing proper risk and compliance protocols, bad things are going to happen. And we can't go beyond, we can't move to a fast payment system, we can't move to an efficient payment system until we deal with the risk and compliance issues that must be dealt with. I'm not going to go through this. One of our customers owns a bank in Brazil, and again, this is amplifying the challenges with an SME and a bank. They do about $3.6 billion of cross-border payments to the United States every year. The average transaction is $252,000. So this is a bank that specializes in B2B payments to the United States. One of the first challenges for that bank is in order to open a correspondent account at the US, the American bank wanted 1 month's average transaction volume. That's only $300 million. So you can imagine the hit to the balance sheet as well as the profit and loss statement of the Brazilian bank trying to account for all of that cash as well as the volatility. But the customer experience, the SME's experience is when they press send on the website in Brazil, in their mind, money went flying to the United States. But there was already, by the way, they negotiated the $300 million down to $100 million. Woohoo! But the customer thinks the money goes flying to the United States. The money was already there. $100 million is sitting there. And this is an average experience. 5 days later, the customer calls the bank to say, where's my money? Why hasn't it been delivered to the United States yet? And that's when a human being in the back office at the bank says, sorry, Mr. Customer, we've just been really busy. Let me look at your transaction. And they turn to their email and they see a payment instruction that says, customer A wants to send $252,000 to the US. Now they turn to their risk rules and their compliance rules, and they'd be going step by step by step through them. Can I do this payment? Oh, I can do the payment. We have an account in the US. The customer has money. Great, it's more than $100,000. What do my risk rules say? Oh, I need a bill of lading. I need a customs declaration. I need an invoice. What does my central bank say? I need this. I need a contract. I need this. A human being is going through all of those steps 5 days after the customer pressed send. Now they're asking the customer to send the documents in. So the customer's faxing the documents in and emailing the documents in, and now they're reading them. Does this look like it's been forged? Has this been altered? Are there any sanctioned vessels in here? Are there any sanctioned people in here? Do the dates match up? Listen, for those of you who work in banks and central banks, God bless you. This is the worst job on the planet. I don't know how you do it. I don't know why you do it, but thank you for keeping money moving. This is insane. They may have hundreds of pages of documents to review, to execute on the risk and the compliance obligations that are necessary. And by the way, remember what I stated in the beginning from the United Nations. Even after all of this work, there's still $2 trillion that fails that gets through the system. It's not your fault. It's because you've never had software. You've never had a system that says, when the customer presses send, let's execute the rules systemically. Let's determine what needs to be collected. Let's collect it digitally. Let's use AI to analyze the non-structured data in all of those documents and extract names of vessels, currencies, owners, dates, product names, descriptions. Let's use AI to look at the videos and the photos associated with the transaction and judge whether that transaction appears to be legitimate. And the transactions that fall into a category, now they get reviewed by a human who has a package to look at. The results of the AI, the results of the analysis that says, look at this, look at this, look at this. Instead of spending hours, days, or weeks, they can spend a couple of minutes and have a digital package that they're able to respond to. And the majority of transactions are going to pass seamlessly. So we're going to check the box of risk has been addressed, automation, efficiency has been addressed. But those that get highlighted now, there's a data package that lets someone respond to it. Now, when the person finishes the very end of the process and they turn to their Wells Fargo interface and they type the transaction into Wells Fargo and they press send, the beauty of the Swift system is it's fast. It's a couple minutes and it's there. But we're measuring the wrong thing. The customer their experience began when they pressed send on the website and they waited 5 days and the money wasn't there and they called the bank to find out why it wasn't delivered and they started giving them all of the information and now a human being had to resolve it. What's really disappointing is that so many folks in our industry want to measure the time they press send on the website at the bank and how quickly the message went through Swift rather than the customer experience, which really sucked. So now Wells Fargo receives the message and they turn to their terminal and they manually type the transaction into it. This system is broken in that transaction, Wells Fargo has no idea who the disperser is, who owns the disperser, what sanctions checks were done on them, what their commercial activity is or source of funds, and why they're paying someone in the United States. They're operating on trust. That's the essence of correspondent banking, and the root cause is the absence of software to fix this. This is why cross-border payments have historically been high risk, inefficient, opaque, and not inclusive. The not inclusive part we sort of gloss over, but in today's world it's really important because if you are an entrepreneur in Ukraine or in the Philippines, you may not have a bank account. And you're selling something on Etsy or Amazon or eBay, how do you get paid? We're going to come back to that. The world and the financial institutions need better product. And by the way, one of my dear friends used to be the chief product officer and chief technology officer of one of the US's largest banks. And we had lunch a couple of years ago, and the poor guy, he didn't look well. He used to be the global chief product officer, and the CEO of the bank got tired of hearing him complain about how he couldn't get innovation out of the technology team. So the CEO made him the chief technology officer. This is a true story. And he said, you know, Gary, as a chief product officer, I was so upset at the CTO all the time I couldn't get new products. But now as the CTO, I just hate the world. I'm like, okay, what do you mean you hate the world? He goes, 90% of my IT budget is sucked up doing 3 things: protecting data and systems, keeping 8,000 different systems operating. I have 8,000 different systems. And I've got 500 regulated products where the rules are always changing. 90% of my IT budget's protecting data, keeping my systems current, and keeping my products up to speed. I can't innovate. And I've got these 500 products they're hungry for innovation. Guys, I can't be any other way than pragmatic. The problem has been the absence of software, and banks don't have the dough to do it. I was with a CTO of a small bank in Greece yesterday. It's a relatively small bank. They've made a series of acquisitions over the last 7 years. They have 5 different core systems in the bank. Think about that. A small bank trying to deliver a single product, someone's smiling, across 5 different, none of you have that experience, I'm sure, across 5 different core bank systems. We have an issue. So what's the solution? It's really simple. Software that's actually designed to automate these things I described, and new paradigms to correspondent banking. And I see that MasterCard's a big sponsor, so hats off to MasterCard. You're going to hear a lot about that. So the first point here is that, and if you kind of take a step back and look at other industries, there is infrastructure in other industries. IATA manages and connects to global reservation systems for hotels and airlines and travel agents. FedEx has built a remarkable global system for shipping goods and delivery goods and collecting payments and executing tariffs and all of that. There's never been infrastructure for cross-border payments. Just think about all the software issues I described previously. It's a proof point that it doesn't exist. So what we've built is software that's used by the entire ecosystem. Central banks use it, regulators use it, domestic networks use it, and we're not creating a network. We are able to help solve a solution inside either an originating institution, a correspondent bank, or a central bank. I won't go through all of the products, but the fact is this was purpose-built for cross-border. It's not some system that was a core system that was modified, or some compliance system that was modified. It was built from the ground up to solve every single manual task and technology and payment orchestration need and compliance and risk orchestration need of a cross-border payment. That's the core of it. And in fact, some of the key breakthroughs are that for the first time ever, remember I said that Wells Fargo got that transaction and they didn't know who the sender was and they didn't know anything about it? They would know if they would go to the respondent bank or the originating bank and ask for data, which is about 0.00001% of all times. And they know when they go through an audit process with either internal or their external examiner to try to see, can we continue trusting this foreign bank? Are they actually following their anti-money laundering rules they said they were going to follow? Are they following their risk mitigation rules they said they were going to follow? Are they following the KYC rules? And so periodically, a big correspondent bank will go through this process. Now, I'm working with a correspondent bank in Turkey that has 200 originating banks across Africa. Now, they get 10,000 emails a week back and forth between those banks, with bills of lading, customs declaration, and invoices all associated with them. They're going in digital folders, unaffiliated with the payment, because there's never been software to automate the collection of that, automate the sharing of that, digitally store it around a payment. So now for the first time ever, Wells Fargo, going back to the Brazilian bank example, on 100% of all payments coming into the bank, knows who the disperser was, what sanctions checks were done, what are the results of electronic ID verification, what's their commercial activity or source of funds, why are they paying someone in the United States, and they have the result of an AI package that says, this looks legit, for the first time ever, on 100% of all payments. So a central bank can have the same benefit. Every payment coming into a country, every payment leaving a country. A domestic network can have the same wrapper around it. In January, we go live with the Federal Reserve Bank. We're building a direct connection into FedNow, ACH, and FedWire. We expect to be live in January. But banks that use our system will have an ability to have that insulation around, that protective, that digital Kevlar protecting their system and the domestic payment system. But for the first time ever, every touch point can have their own set of rules, risk and compliance rules, and they're digitally executed. But what's really cool is at the end of the chain, the final bank that's clearing the payment, they can actually see what were the originating bank's rules and how were they executed. What was the correspondent bank or intermediate bank's rules and how were they executed. For the first time ever, absolute transparency to the entire payment. Now let's talk about new paradigms. I'm really excited about this, is that MasterCard, and I want to pause for a second. Many of you have experience with cards. Do you know there are 3 assets inside MasterCard that make it far more valuable as a cross-border enabler than you could ever imagine? Think about how when you use a card somewhere else in the world, isn't it magical that when you go to the UK, you pay for a coffee, and what's happening is you've got a card with Moldovan lei, but you just paid for something in pound sterling. And it's like, gee, it's kind of magical. It is magical, and there are 3 reasons why. And there are 3 deep assets inside MasterCard that make it possible. The first is, in every country where MasterCard operates, they're connected to the bank transfer systems. Why? Because they have to pull money from the Moldovan card issuer, and they have to give it through a bank transfer system to the UK card acquirer. The second asset is they have massive global liquidity, because they pull Moldovan lei, or in most countries they pull the local currency, and then they give the bank in the merchant country the local currency, so they give pound sterling. And MasterCard sets the exchange rate and processes nearly $2 trillion of foreign transactions every year. So these 3 assets, which are invisible to us who use cards, are very powerful capabilities inside MasterCard. Well, they've spun that out in a separate business, and they say to banks now, listen, you don't need a correspondent bank anymore. You don't need to buy $300 million in foreign currency. Here are APIs. Tell us what currency you have, tell us what currency you need and where you want the payment to go, and we'll use our infrastructure to take care of the rest. It's fascinating. And when Ajay Banga was CEO of MasterCard, he had this overwhelmingly powerful notion to help all classes of society, and he built an inclusive mindset. And MasterCard built connectivity into mobile money networks around the world, digital wallets, cash pickup systems around the world. So for the first time ever, a bank could say to its customer, you can send money to someone in the Philippines, and even though only 1/3 of the population has a bank account there, you can get money to everybody in the country through the bank system, through mobile money, through cash pickup, which is remarkable. This is what MasterCard makes available now if you're an EMI or you're a bank in just about every country on the planet. It's a fascinating new service. Now, there's one challenge, just like on card issuing and card acquiring, you get a big stack of operating regulations, and it usually takes, this is just how the world works, up to 1 or 2 years to connect to the system and a couple $1 million to build a connection. So as I mentioned, there's a little bit of a resource problem, but that's what we do. We're MasterCard's partner. We're already connected to MasterCard. We have banks live in the US, Africa. We're launching in Asia, across Europe. So we help financial institutions get live with MasterCard cross-border in 3 months or less for about $25,000. So about 1/3 or 1/4 or 1/5 of what you pay just to consultants to find a correspondent bank, you get a much better product. The other reality too is we did a demo about a year ago for a bank in the US on a Friday night at 7:02 p.m., so 1902 hours. We sent €5 to Portugal. And the CEO of the American bank said, Gary, you're just wasting my time. I process my payments through PNC, that's my correspondent bank in the US. The funds will get there next Tuesday. Why are you wasting my time on a Friday night after the bank's closed, everybody's closed, and sending money to Portugal? The funds arrived 4 minutes later at 7:06 p.m. in the US, at 6 minutes past midnight in Portugal. And the full €5 arrived. There was not the negative €20 taken out of the account for the cross-border fee. This is the power that MasterCard's taking to financial institutions around the world, giving them an incredibly powerful product. But we're also, I won't go through all of this in the interest of time. The point is that as a bank, you not only have a safe product and an efficient product, a product your customers love, a product that reaches everybody on the planet, but a product that's very profitable. We're also connecting domestic networks. So as I mentioned, there are new paradigms. MasterCard represents a new paradigm to correspondent banking. Domestic network to domestic networks are new paradigms to correspondent banking. But for these paradigms to work, you have to fix the risk and the compliance and the payment orchestration problems. So it goes back to having the right software to deal with the things that there's never been software to deal with efficiently before. So what does it really mean? This is it. For the first time ever, there's been infrastructure built for financial institutions, central banks, originating institutions, and correspondent banks so that they can actually offer a safe, an efficient meaning fast and low cost, transparent, and inclusive cross-border product. Financial institutions that have been beaten up for years because of an inability to stay ahead of money laundering and terrorist finance, and unable to keep ahead of some fintechs that are offering seemingly better products, and you're kind of wondering how they can do it. Financial institutions now are in a position that they can offer products that feel and act and look like the very best fintechs. So that banks now can either power fintechs and partner with fintechs or compete and win. It's the bank's choice. But it's only possible for the first time ever because there's new software and there are these new paradigms like MasterCard and central bank to central bank that make it all possible. I hope that made sense to everybody. I've been here for a couple sessions. There haven't been many questions asked, but since I've got a couple minutes left, I'm happy to take a few questions if there are any. And if not, we'll get 2 extra minutes back. Okay, thank you very much. Thanks.